on the US presidential debate, and it was moving down. So part of the weakness for the sector here domestically can be attributed to that story in Asian trade, some profit-taking kicking in. Let's cross to Pete McGuire, speaking of commods, in the house at our Sydney CBD studios, CEO of XM.com. Pete, warm welcome to you. Lots of moving parts, always is, in the energy complex. You know, you've got the OPEC meeting, you've got today's moves, and of course somewhere in the middle you've got inventory reports that are pending out of the world's largest economy. So what are you saying is likely to happen next for prices?
Well, good afternoon, Carson. What a question. You know, you've got the Energy Forum over in Algiers. We're all very much aware of what's going on there. It's a three-day think tank. As far as OPEC's concerned, you've got the big movers, as you know, the Iran, of course, what's happening with the Saudis and Russia there, and they're taking the view that we're going to move forward up to the 30th of November. We feel as though that there won't be a lot come out of the particular meeting or this particular workshop at the moment, and moving. It's going to be far more interesting, and I think it'll be a little bit more groundbreaking come 30th of November in Vienna. Well,
you know, we've had these marquee meetings before today, many of them lost count, if truth be told.
Yes.
You know, you could bet your bottom dollar you could go into TAB now and do very nicely from a no resolution outcome. Pete, why are we again betting the house on this?
Well, I think one of the major issues, Carson, is that you've got such a you've got the small, nimble players, being the Venezuelans and so on, that whilst that you look at costs at, you know, $60 to $80 as far as retrieval, they need the big dollar value. They want the $80 to $90, and there are many of those OPEC players. Then you've got the larger position players that are looking at, you know, the $5 to $25 retrieval costs. Someone like the Saudis with 500 million in foreign reserves. So they play in a different field altogether. And you've got the three largest players in the world being Saudi, Russia and the US as far as producers. So it's a time and a space at the moment. Very, very conflicting views, and we've all seen the big washout. It's just continuing, Carson.
We kind of, in this part of the discussion, always reference Baker Hughes, and that's when I turn to my right and
511.
Todd. Yeah,
511 for Baker Hughes. They keep going up.
Yes, they are. I mean, there's no doubt there, Mark. And you know, we're up from those lows, you know, the mid 300s.
Yeah.
We're a long way to go to get to 1400, what we experienced in 2014. But over 500 shows that the market is nimble. It's also prepared to, you know, add count. And whilst we've got the position at the moment of $45 to $50 a barrel, more players are coming in. Another thought that you probably put your mind across from producers. The rigs were looking at, you know, a cost of between $60 to $80 as a true cost. They've now brought that down to $40 to $60, Mark.
That's incredible, isn't it? And when you think about how nimble that's the US economy, isn't it? It wants to, I mean, Pete, let's not hold our breath to get to 1400. That will not be happening for quite a long time.
I think so, Mark. It's probably like the Nikkei.
Yeah, but it's interesting about, and Barings are still suffering. It's interesting how, when you think about the nimbleness of the US market, they continue to get these things to work. What it does to the job market and what it's doing into that part of the US, you know, it's a great advertisement for the US as opposed to what you now see in Europe. You know, they just don't have that nimbleness.
Well, exactly. You know, in Iran, you roll it across to Iran, roll it across to the Saudis. Iran's wanting to be more like, you know, that 4 million, 4.2 million barrels a day. Saudis are running 10 million. And you've got cheaper production. Even you saw the Stat Oil numbers coming out of Norway. They're running a $25 retrieval. So that North Sea is, everyone's producing for cheaper, and that's all rolling into the market at the present. So I think the world's going to be awash with more oil rolling into 2017.
So, Pete, how do they come out of Algiers in terms of, can you write the press release now? You know, you could write it and say, this is what we're going to say, and it doesn't necessarily have to be based on any sort of normal world, anything that they will come out with a positive bias, or are they prepared to put their hands up and say, you know what, this is just a bit too hard?
Well, I think it is. It's too hard to get resolution. You've got to also consider that Iran, from a geopolitical side, has got a presidential election shortly.
Yeah.
So roll that across, then think about this is just a pathway to more or less keep the momentum moving forward to that 30th of November. I truly think that meeting in Vienna will be one of the most important in OPEC history because of the current situation. And then you've got something like Kashagan from Kazakhstan, one of the largest fields ever found, and it's been a delay for the best part of a decade. That starts next year.
But, Pete, what I mean is there a chance that somebody might come out and say within OPEC that, look, it's just not going to work. We'll have to come back to you in a few years' time, but in the interim, we need to sell a few assets and try and work out how to fund our growth.
Well, that leads you into the IPO as far as Saudi Aramco. Yeah. There's no doubt that 17 will be the year that they probably kickstart that particular venture and take it to the market. So where the market's moving forward, there's a lot of companies and, of course, sovereign wealth and countries hemorrhaging, and the oil market is just a wonderful example of that.
Let's just get your perspective as well. We touched on it earlier. Coke and coal, moving into some of those industrial commodities, is kind of just beyond simply the oil price.
Yeah.
And the reminder, this was coming from the head of metals and mining research at HSBC, Jeff Yuan out of Hong Kong, pointing out that a key challenge is that the production control rule from the Chinese is a short-term measure rather than any move that permanently removes capacity. That we know in the past with other kind of arbitrary rules that kick in, they can then change very quickly.
Well, they can, Carson. First off, it's a benefit to the Australian miners and, of course, Indonesia. Secondly, the market's up 40% and about 130% for those two, thermal and coking, over the last 3 months. So it's, off the Richter scale as far as growth. And then putting it from the composition, the Chinese have cut mining days from about 330 a year to about 275 a year. So less time at the mine, and that's another reason why you've seen that price move very, very strongly to the upside.
Maybe you need the Chinese at that OPEC meeting. That was kind of my segue. I'm being very facetious, but they can do it because they click their fingers, right? Yeah,
but look, the growth coming out of China, it's going to continue to be very, very strong over the decade ahead. The situation quite clearly is there is too much production. And what Kashagan could do in the larger fields, they come into play. I think it's going to be a race to the bottom. And, China, it could be the same for India. We might be heading for a $35 to $45 benchmark as far as crude. So more production. That's why I say that meeting in Vienna really could be a very important observation and time for OPEC to really realise where the market is.
And on that kind of forward-looking note, we will thank you. We'll move on. Pete, thanks as always.
Thank you,
McGuire,
Carson.
CEO of XM.com, live in our Sydney CBD studio. Panel